This is John Prasinos, Editorial Director of Investing Daily, with a video presentation for Monday, April 26. To view our full range of publications, visit our website at www.investingdaily.com. Fear and greed animate all markets, causing stocks to be either overvalued or undervalued. Even during this long bull run, you can find opportunities to buy stocks below intrinsic value and to sell when they're at or above that level. I typically don't look for relative value, i.e. against other stocks in the same sector, but instead focus on absolute value. In the stock market, today's laggards can become tomorrow's winners. We're currently in the midst of a market rotation whereby value stocks are outpacing growth stocks. Take a look at the following chart. The iShares S&P 500 Value ETF, year-to-date, has generated a total return of 13.7% compared to a year-to-date return of 9.4% for the iShares S&P 500 Growth ETF. As of market close April 23, value should continue beating growth this year. I consider myself a traditional value investor and also a contrarian. I'm always seeking out negative news. When others move out of a stock because of a short-term hiccup, I consider that a buying opportunity and relish this type of bad news-induced volatility. You should too. We saw a quick news-triggered decline last week when President Biden announced that he would seek new taxes on the wealthy, including a near doubling of the capital gains tax for people earning more than $1 million a year. When the news of the proposed tax hikes broke, stocks immediately tanked. But investors came to their senses on Friday, shrugged off the prospective tax hikes, and the market sharply rebounded. Still, the markets had a down week. See the following table. The table you're looking at shows that oil prices have made a substantial comeback year-to-date due to expectations of economic growth. For most energy companies to produce oil profitably, crude needs to trade at around $50 per barrel. Current oil prices are a far cry from the lows of last year. As you can see, international equities have been rising this year, along with the U.S. benchmarks, reflecting the implementation from overseas central banks of aggressive stimulus measures, as well as a general containment of the coronavirus. Also lifting overseas equities have been better than expected manufacturing data from Europe and Asia, particularly China. In the U.S., unemployment continues to fall, fueling the stock market rally. Take a look at the next chart. The Labor Department reported last Thursday that first-time claims for unemployment insurance totaled 547,000 for the week ending April 17, below the 603,000 consensus estimate. The total represented a low since the coronavirus outbreak in the U.S. For context, jobless claims reached a jaw-dropping 6.2 million in early April 2020 in the initial days of the pandemic-induced economic slowdown. Unemployment is still high, but it's trending in the right direction, and that's down. As consumers and businesses get healthier, economically sensitive stocks will continue to rise, especially those that still trade at reasonable valuations. The confluence of all of these factors point to an economic and stock market boom in 2021, even if taxes are increased. Sure, Wall Street hates taxes. Everybody hates taxes. But that sentiment is offset by the financial community's enthusiasm for Biden's proposed fiscal stimulus and infrastructure spending. So, don't overreact to the headlines. If you get too cautious, you'll incur an opportunity cost. The pundits on television who are predicting an imminent market crash, well, frankly, they're partisan hacks, and they don't know what they're talking about. We may experience a few temporary sell-offs this year, of course, but conditions are favorable for a long-term continuation of the bull market. Okay, that should do it for now. If you have any questions, please don't hesitate to reach me at mailbag@investingdaily.com. Have a safe and profitable week.